Okay. Um, the next thing we're going to take a look at is the closing process. Now, if you watch the accounting cycle video, you remember that one of the last things that we do is this closing process, and what that does is it kind of zeroes out the temporary things and it updates our accounts, right? So we got to get ready for our next accounting period. So the closing process is where we're headed with this, right? So let's go back to our income statement. We're going to look at our income statement, right? So this happens to be page 151 of your textbook, right? So we have our income statement. Now remember, what kind of accounts are on our income statement? Well, revenue and expenses are on the income statement, right? The other thing I want you to pay attention to is the date line for the income statement says what? For the month ended. So what that tells us is that on an income statement, I'm measuring from when? The beginning of the month, December 1st, through December 31st, 2015, right? So that's the period that I'm measuring for. Now, before I get ready for January 1st, 2016, I have to do what with these accounts? I got to click them back to zero, right? Because otherwise, we'd be counting last year's revenue, right? So I know that before I can get ready for next period, what has to happen to revenue and expenses? We got to click them back to zero so we're ready to count for our next accounting period. We know that because this says what? For the month ended, right? So it's a period statement, meaning it from the beginning to the end of the accounting period, right? So what that tells us, these got to go to zero, right? Now, if we look at the statement of owner's equity, we notice what? That also says for the month ended, meaning this is a statement of owner's equity from when? The beginning of the month through the end of the month. This is the statement that accounts for the four things that affect owner's equity, right? Now, this is again a period statement. It deals with investment, revenue and expenses, and drawing, right? Now, investment, when we do investment, the person invests in their business, we just put that right to their capital account, right? So that's not really part of this. But income is what? Net income is revenue and expenses, which we just said we had to do what with at the end of the period? Click them back to zero. Same with withdrawals, right? I can't start counting next year's withdrawals until I have a zero balance in my account for this year, right? So I know that those are things that are temporary. They only hold balances for a period of time, and then I zero them out and we accumulate for the next period and so on, right? Now, if we look at our balance sheet, if we look at this balance sheet, right, we'll notice this has a very different date line. This just says what? There's the date. Because this isn't a period statement. This account, this carries balances across periods, right? Think about it. We don't want to reset our cash back to zero, or we don't want to reset accounts receivable back to zero, and we might like to reset our accounts payable back to zero, but we can't, right? So these are permanent accounts. They carry balances across accounting periods, and they are on where? On the balance sheet. What's on the balance sheet? Assets, liabilities, and owner's equity, right? Those are the three balance sheet accounts that we have. So what that means is, right? What that means is that we really have two types of accounts. We have temporary accounts, which hold balances for a period of time, and we have permanent accounts, which hold balances across accounting periods, right? Now remember, income statement, we said what? We had to take and reset those back to zero, right? So we know that revenue is a temporary account and expenses are a temporary account because we have to reset them back to zero, right? And we also know that drawing holds a balance for just the period of time, right? So if you're the kind of person that builds acronyms, right? Revenue, expenses, and drawing, red, if that helps you remember it, right? Permanent accounts are easy because permanent accounts are just what? Our balance sheet accounts, right? These are the accounts that carry balances across accounting periods, right? So we have temporary accounts that we zero out, and we have permanent accounts that carry balances across periods. Now, if you think about it, these are all things that affect owner's equity, right, or capital. So what we do in this closing process, it has two purposes, right? This closing process has two purposes. One is to do what? Zero out our temporary accounts. Zero out our temporary accounts, and we want to do what with those balances? All of these things that are they all affect owner's equity, right? So we also want to do what? Transfer their balances to the capital account. right? So in this closing process that we're doing, we want to take these temporary accounts, we want to zero them out, and we want to transfer their balances to capital, because revenue does what to capital? Makes it go up. Expenses and drawing make it go down, right? So that's why we do these closing entries, is to zero out our temporary accounts and to transfer our balances to the capital account. We're going to do a little example of this closing process where we zero out our temporary accounts and transfer their balances to the capital account. I've set this up here so we've got some T accounts, right? And I got a handful of accounts here. And we're going to go through the process of closing these accounts, closing the temporary accounts, and transferring their balances to our capital account, right? Before we start, let's review a little bit. Fees earned, we know, is what kind of account? Fees earned is revenue. Revenue accounts have a credit balance, right? Wage expense is an expense account with a debit balance, as is auto expense. Capital is a owner's equity account, credit balance, and drawing is contra equity, so it is the opposite of capital. And income summary, it doesn't have a nature, right? We're going to talk about that when we talk about this closing process, right? When we talk about this closing process, we'll deal with this income summary account. So we're going to go through this 4-step process, right? So 4 steps to close, right? 4 steps to close our accounts. We know the very first one, well, we don't know, but the first one is close revenue to income summary, right? That's step 1. I'm just going to list these out and then we're going to go through and actually do them, right? The second one is close expenses to income summary. Our third one is close income summary to capital. And our 4th step is close drawing to capital. So there's our 4 steps in the closing process. Each of those steps is a journal entry, and each of those things takes us towards closing our temporary accounts and transferring the balance to capital, right? So I didn't really leave myself enough room, but we're going to go through these steps kind of one by one. We'll see how this goes, right? Step 1 is to do what? Close revenue to income summary, right? So I need to do a journal entry for step 1. I want to close my revenue account. Well, if we come over here, the revenue account we have is fees earned, right? Fees earned is my revenue account. To close this, I'm going to do what to this? It's got a $1,000 credit balance. I'm going to have to do what? Debit fees earned. And I zero that out with that debit to fees earned, and I move its balance to income summary. So I debit fees earned and credit income summary, right? Income summary, not income statement, income summary for that $1,000, right? So that is step 1 in the closing process. Now let's post this and see what happens. I post this $1,000 to fees earned, and that account goes to 0, right? And the credit side is income summary gets a credit of $1,000, right? So that credit represents what? Revenue, right? In my income summary account, that's revenue. Fees earned goes to 0, right? So we've closed our revenue account. Now we're going to do step 2, right? So we're going to close. Step 2 says, what does step 2 say? Close expenses to income summary, right? So we know we do what? 2 expense accounts, and we have to close them. They have debit balances, so I know I have to do what? Credit these to make them go to 0. If I credit these, I have to debit income summary, right? So I debit income summary. Don't know how much, right? Because I gotta list my other side first. I'm going to credit wage expense for $250 and credit auto expense for $300, so I know that my debit is $550, the sum of the 2 credits, right? Now, if I post that, watch what happens. $550 on the debit side of income summary. Wage expense does what? It goes to 0. Auto expense, credit of 300, and that goes to 0. Now, we've closed revenue to income summary, we've closed expenses to income summary, right? So I know what? This represents revenue, and this represents expenses, right? So if I balance this account, I have a what? $450 credit balance. Well, that should be net income, right? That's net income because that's revenue and that's expenses. So revenue minus expenses is net income. Credit balance, right? So step 3 says to do what? We are going to take that income summary account and we are going to close it to capital, right? Income summary, we're going to close to capital. So step 3, credit balance, I gotta do what? Debit that to make it go away. Income summary, and I'm going to credit capital for $450, right? So there's step 3. If I post this, what happens? Income summary goes to 0, right? And capital gets a bump of $450, right? So we know that we've always said that net income makes our capital go up. Well, here's the mechanical process where that happens, right? I do that 3rd step, and what happens? My income summary goes to 0, my capital goes up by $450, right? Okay, so there's step 3. Step 4, close drawing the capital. So I got to do what? I got to close my drawing account. I'm going to do that with a debit, right? I'll just come up here and cover that up. Number 4, right? I got to do what? I got to get rid of drawing, so I'm going to credit drawing for $200, and I close drawing to, what does it say? Close drawing to capital, right? Close drawing to capital for $200, right? Now let's watch what happens. This drawing account does what? Goes to 0, right? And capital is it gets a debit of $200. So we've always said drawing does what to my capital? It makes it go down, right? Well, this is the mechanical process how that happens. Let's foot and balance this account, right? 10,450 minus 200 would be $10,250, right? So that's my ending capital balance. After I've closed my accounts, fees earned, temporary account, what happened to it? It goes to 0. Wage expense and auto expense, temporary accounts, they go to 0. Drawing is a temporary account and it goes to 0. All of those account balances are transferred to capital, right? Now this income summary, we didn't ever define it. It's just a little bucket that we use in this closing process, right? To catch all of these things. So it's really ultimately the most temporary account that we have. It doesn't really have a nature though, whether of an account type. We just use it in the process, right? But look what happens. All of these accounts are now at what? 0. And every dollar that was in those accounts is now included in the balance that we have in our capital account. So remember, the purpose of our closing entries was to do what? Zero out our temporary accounts and transfer their balances to capital. We do it through this 4-step process, right? Close revenue to income summary, close expenses to income summary, close income summary to capital, and close drawing to capital, right? Those are the 4 steps in our closing process. So in the big picture of the accounting cycle, right, this does what? It zeroes our temporary accounts, gets ready for next period, and moves their balances to capital, right? So that's the process of closing our accounts.